This is Invested in Climate with Jason Rissman. I see climate as the world's biggest, most diverse, most important movement in human history. Millions of people dedicate themselves every day to protecting the planet. This podcast shares conversations with advocates, entrepreneurs, investors, policy experts, and anyone else that can push our thinking about what's possible and what needs to happen to address climate change. If you have ideas for episodes or feedback, get in touch on LinkedIn. If you enjoy the show, please leave a rating on Apple or Spotify. I'm currently building a new venture. It's related to storytelling and how we engage all sorts of folks in meaningful climate action. If you have expertise in this area, big ideas, or examples of something that's really working, get in touch. Thanks for listening and for doing whatever it is you're doing to support climate progress. Okay, let's get started.
The climate crisis, I think, will be predictable. There's a way for me to help and be impactful with people by hedging the risk of it happening and making sure that society's in a good place. We can still live a good quality life, even if it does happen.
Hi, everyone. The vast majority of my interviews have focused on innovations, investing, and advocacy related to climate mitigation. That is, what we can do to cut greenhouse gases and minimize the rise in global temperatures. What we do or don't do now will have lasting consequences, and it is climate mitigation that is driving the transformation of the global economy. So it's not surprising that mitigation dominates climate investing. Adaptation and resilience, meanwhile, focus not on limiting reversing climate change, but rather on improving quality of life in a warmer world. Adaptation ventures receive only a small fraction of climate investments, but rising temperatures are creating tremendous demand for a new category of products. Boston Consulting Group and Temasek estimate that between $500 million and $1.3 trillion could be spent annually by 2030 on technologies that help people adapt to a changed climate. That's the opportunity Darren Clifford is targeting with a new fund called Adaptus. Darren has worked for 2 decades on new markets as a founder, consultant at McKinsey & Company, and as an angel investor. And I found his perspective on the climate adaptation market to be packed with nuance and insight. We spoke about his background, 3 different categories of adaptation tech, the unique challenges they face, how they'll make the future more livable, and much more. Lots to learn and think about in this one. Enjoy. Hello, Darren. Welcome to Invested in Climate. Thanks for being here today.
Hey, Jason. Thanks for having me. It is an absolute pleasure to be here with you today.
All right. So the big mystery, where are you dialing in from? I thought Toronto, but apparently somewhere else. Where are you at?
I find myself in Oslo today, but it is a very fair question to ask where in the world is Darren. I think I've traveled now to over 100 countries in the world, so have passport, will travel regularly. But part of what I'm trying to do right now, Toronto will be my home. I'm just in the process of moving over there after spending the last 5 years living here in Oslo, which has been a wonderfully beautiful experience to have.
So I take it you missed Toronto's first inaugural Climate Week, which I think was just last week. Were you there for any of it?
I was not only there, I was on stage all day at the True North Rising and not like kickoff event. And I was the master of ceremonies for that.
Oh, very cool.
Like it was just an amazing event. And I think Becky and the people who really put on the event behind the show were just spectacular. We got a lot of compliments of just how professional it seemed for a first event that was there, and some great support throughout the community of Toronto. I really think it is the first of very many. And it's also going to be something that will lead to impact. One of the things we kept challenging the audience is what will they do differently coming out of that session? I really think it'll be a wonderful thing to have happen.
Amazing. Any sense of how many participants or events or how much reach the week had?
I think at our event, there was around 300 people who attended. And then there was going to be around 100 events over the 3 days that they did for the inaugural session. And so it was definitely something that you saw a lot of demand for in Toronto to keep moving forward there.
Fantastic. Well, loyal listeners will know that I'm excited about the spread of Climate Weeks and recently aired an episode with the founders of LA Climate Week. So it was great to see that Toronto launched its own first event, and so many attendees and 100 events for a first time efforts is really exciting. And I'm sure that you are right that it will continue. Darren, let's get started by getting to know you a bit. Tell us a bit about your background and how it led you to focusing on climate.
I always joke, I'm just a kid from a middle-class family in Canada who grew up with the best advantage in life you could ever ask for. I have family and friends who have supported me across my whole life and who have loved me and said I could go do anything and then kicked me out of the house. And so in that way, I stand on the shoulders of giants with the people who have come before me and I've learned from. And they've always, not only did it create opportunities for me, it allowed me to think in the world about also how could I give back and how could I contribute. And so my career, though, it started in the financial markets as a prop trader for 10 years, starting and selling in businesses in that space. Then I went on and went to Rice University to do my MBA, where I co-founded an accelerator program that's still in its operations. It's called AlloSpark. It's been now, I think, 12 or 13 years running after we founded it and I ran it for the first year. And then I spent 11 years at McKinsey, the last 4 years in our green business building practice. So helping early stage sustainability companies grow and scale. And along the way, I've also been angel investing for 15 years. I come with this bit of a unique background of having been an investor, having been a founder, having been an operator, having also been a consultant, seeing a wide range of different industries. I would say I'm not an expert in any one industry in any way. That's definitely not it. It's much more around how do you scale businesses and how do you help these early stage businesses get from 0 to 1 in a wide range of industries. That's where I really spend my time.
Amazing. And so what led you to focusing on climate?
When I think through this about where can I be positively impactful with people, this is really something that for me resonates. Climate as a space I can go and do this, where I think unfortunately it's going to be inevitable that we see climate change happen. The climate crisis, I think, is going to continue. I wish and I hope I'm wrong, but my heart tells me one thing, that we will solve it. My brain tells me another, that we won't. And when I think through this and I think about how then I can help society, my way I can contribute is to actually use capitalism for good. And to do that by getting us ready so that we can, as humanity, still live a good quality life, even if the climate crisis happens. And this comes, you go back to my background in the trading space, right? The trading is so much of it's about hedging and making sure that you still manage for different risks. So much of it is about predictability, and you take advantage of predictability to try to use that to gain an edge. And so you actually start seeing this common thread that's developed through the story around the climate crisis, I think, will be predictable. There's a way for me to help and be impactful with people by hedging the risk of it happening and making sure that society is in a good place. We can still live a good quality life, even if it does happen.
Thank you for that perspective. And we will dive into really deeply here about your focus on adaptation and the assumptions around it and the opportunities that you see. Before we do that, you mentioned that you've invested in a wide range of companies. You've been angel investing for 15 years. And I noticed that some of that range is a bit surprising, right? As you've invested in a closet organizing company, a fast casual restaurant concept, and a company that does healthy, sustainable meal prep. I'm curious, what did you learn from investing in this sort of range of companies and working with their founders?
Some of these are definitely not like the others, right? That I'll readily admit to. You think about the Closet Organizing Company, which is a franchise for Closets by Design out of the US, but truly I bought that with my brother. And my brother runs that, and he's doing a great job there. And he's really driving that business there, the franchise for Northern Toronto. And so what am I trying to do there? I'm trying to be impactful with my family and create opportunities for my brother that he wouldn't otherwise have. You look at the other businesses I've invested in, they all have an impact thread going through them. So the fast casual restaurant concept is a company called Chop and Block, which is trying to bring West African food to be mainstream in the United States. If we're successful, it's basically going to be the Chipotle, if you will, of West African food. And that will expose more people to the West African culture and be a drop in the bucket of race relations. Now, Opie, the founder, Opie Emasu there, amazing individual. And his secret superpower is his ability to just really bring the brand and awareness to the world. And they just got ranked one of the top 50 restaurants by the New York Times in the United States. So doing a great job there. healthy, sustainable meal prep company that is about looking at the supply chain of what everyone will want to live a good, healthy life when it comes to food and making it conveniently at your door. So how can we help people to eat better and live better around food and deal with some of the upcoming changes that we're seeing in the space with supply chains? So there's this impact lens through each of these different companies. But even better than that, for me at least, as you think about where it lies with me going forward, is I meet with these founders on a regular basis. And one of the things I've found is that the support you provide in this early stage is so crucial to founders as people. How do you help them as the person that they are that's running a company and actually provide for them someone who understands their business because they've been in with them over a period of time, but also is a fan of them and trying to support them as a person? And oftentimes it's not that complex. It's being an ear that you can actually listen to things and help keep them on the track that they need to be around. Are they prioritizing the right things? Are they dealing with the right challenges? And actually giving them the freedom to be able to let go of some things that aren't that important, right? Oftentimes the founders are so busy doing things that don't move the needle. And to have someone in their corner who says, it's okay if this is wrong and it isn't perfect over here, as long as you help get these things that are important done well. That way they're free to just focus on the things that really matter.
Thank you, Darren. Really interesting to see the impact as a cross-cutting lens for all those different businesses. I wouldn't have seen that just from the headlines of what they are, but I see it now. Let's talk about what you're doing with Adaptus and really the opportunity that you see for investing in adaptation. There have been hundreds of billions of dollars in venture capital investing in climate tech in recent years. The vast majority of that has focused on technology aimed at enabling a transition to an economy that emits less carbon and tries to minimize the damage done by rising temperatures. Your fund has a different premise. Tell us about it.
I think before we even get into sort of like the differences between mitigation, adaptation, and the focus of our fund, I think it's important that we all start at the same spot, which for me is about improving the quality of life of humanity in the long run. I think all of us want to see that get better. And so the reason I'm starting there is that with that lens of improving the quality of life for humanity, through that lens, you can see that there's benefits for both mitigation and adaptation, that we need both to be able to make sure that we live a good quality life that's there. It's not an or, it's an and. Now, the other thing that comes out from this is you look at things like net zero as a KPI that is measured a lot in the climate space. And I actually think net zero is myopic. If we keep focusing on net zero as the sole KPI, we're going to make some poor decisions going forward. Take a look at technologies like air purifiers. Every time you plug an air purifier into the grid, you put a bigger load on the grid. And as our grids are not net zero, that causes pollution. So from a net zero standpoint, you would say you shouldn't be using this technology at all. But yet with all the forest fires we're seeing in North America and around the world, there's going to be parts of the world where you basically need to shut yourself into your house, put on an air purifier so you can still breathe properly. This is going to be a life-saving technology. And yes, it does put a load on the grid, but the trade-offs are worth it for the improvement it does for the quality of life for humanity. So there's this idea, first, we want to make sure that we're all starting at the same spot. How do we improve the quality of life for humanity? Mitigation and adaptation both have value that's fair. But then when we look at this, we see that the climate crisis is really driving about a $9 trillion opportunity in adaptation. That's a GIC report that came out that estimated this by the year 2050. Our view then is as a way of mitigating risk in society, we just assume it's going to be a 2.5 degree pathway. We don't worry about whether it's going to be 1.5 and what's it going to look like. We just assume 2.5 degrees and then think, how do we behave accordingly? We think the fact that adaptation is going to be driven by self-interest rather than how mitigation's been so focused on what we should do. Adaptation is very personal, and it's going to be what you will do as the climate crisis continues. So we're more likely to see behavior change in people that act differently. So this is the defining opportunity in climate, and the investing in climate is actually an adaptation because it's more likely to happen and more predictable rather than mitigation. But some of the data sitting behind this, there's a recent article by Forbes where they were quoting that right now they think it's a 50% probability of reaching a 2.3 degree pathway. So that would be P50 in technical terms, 2.3 degrees already. Yet why is it that even though that's the case, the amount of investments going into adaptation is about 5% of what we're seeing going into mitigation? So it's a dramatically underfunded opportunity that we see out there in the marketplace. Tailwinds, they came out and said it's a $1.4 trillion economy already today. So the demand exists today. It's going to be huge. It's predictable, and it's underfunded, creating opportunities that's there. Now that sort of hopefully lands this idea of great, awesome opportunity, and we great to go after this, but as an investor and as someone who's worried about impact in society.
Darren, you've made a strong case for adaptation investing, but it begs the question, why doesn't adaptation get the love it deserves? Why is it getting such little investment?
Here, at least our viewpoint is they really face a challenge with scaling the technologies. A great example of this is you think about all these resilience technologies that are coming to the marketplace about flood prevention, fire prevention. There are a lot of business cases that are just telling people to go eat their vegetables. You need to go to the gym. We all know we need to do it. We all know it's the right thing to do for the long term. The WRI says that, there's $10.50 of benefits over 10 years for every $1 invested in adaptation. Yet we still aren't doing it. Why? Because we're sitting here and going, hey, that's just an avoided loss. That's a very long-term method of thinking. There's no urgency for me to act today. So the big problem that you need to be able to solve in order to be successful in adaptation is how do you scale these solutions?
Excited to dive in more and hear more about those challenges for scale and particularly how you're setting up a shop to help them. Let's level set and just get an understanding of the firm that you're building, Adaptus. What is it and how far along are you?
Ultimately, we're a pure play venture capital fund trying to drive innovation dollars, so pre-seed to Series A money into the adaptation space. We primarily invest in North America and Western Europe, where there's bigger profit pools that are there. We're unashamedly a for-profit fund because we think that the for-profit motive is the best chance we have to scale the impact that we're trying to bring to the world. So it works from both sides of the equation here. It's a very new fund, so I'm an emerging manager. This is fund one for me and the team that we're putting together. So it's a place where we've been out in the marketplace for about 5 months now. We have some dry powder from me and my personal investments that we can put to work here between now and the end of the year. But then we're raising do a first close at the beginning of next year.
Great. Darren, some might consider focusing on adaptation in some ways to be giving up, to be not focusing on minimizing the impacts of climate or to be minimizing the change in climate. But very clearly, your approach reflects a deeply humanistic intent. And I saw that you've made a commitment to only invest where you can improve quality of life. And you actually have a process for using third-party validation to quantify well-being outcomes. Tell us about this process and why it's important to you.
So, let's start at the end of why it's important to me. And this falls in two categories. The first is why is it important to me as a person who's sitting behind a fund? Ultimately, I am still an individual. And my purpose is to be positively impactful with people. So this allows me to get both myself out of bed in the morning and build the best team around trying to drive the impact that we want to get. So it's a very personal thing about why it's important. But there's also a for-profit motive that's here, which is we feel like as the climate crisis continues, more people will become aware of the choices that they make and want to be investing in companies that improve the quality of life for humanity. And therefore, we're just de-risking the portfolio. So as things change, people will this will become more positive. The fact that we've only from the beginning made that effort to improve or invest in companies that improve the quality of life for humanity. But let me give you an example of both how we would look at this and then also some examples of what it means we would invest in, but other places that we wouldn't. So we have a partnership with a company called Valuing Impact out of Switzerland. They use this equality method or equivalent quality adjusted life year methodology to measure the impact of things. What I like about this company is it makes decisions the way my mom taught me to make decisions. You'll list out all the things that this company or this startup could potentially be doing that would impact humanity. You think about the activity levels associated with it. So it pollutes so much, it creates so much jobs, it pays so much in taxes. All these types of things, you sit here and you try to quantify what is the activity level associated with them. And then their secret sauce is they put a dollar term against them. This is what they do on a daily basis. And this is why I'm asking a third party to do it. So what is the negative impact of a ton of CO2 being released into the environment? That's worth something. What's the value of a job? That's worth something. If we do it, a high paying job in Norway probably isn't worth as much as a good high paying job in a developing country, as far as the impact on the quality adjusted life here, because the opportunity cost is so different. So they do all that type of analysis to then come out and say, after you net out all the puts and takes, does this company improve the quality of life of humanity or not? If the answer is yes, even if it's just by a little, it's now in our investment space. If the answer is no, we take it out of our investment space. So examples, we talked about air purifiers a moment ago, but even air conditioning. Air conditioning is going to have puts and takes. It's going to have pollution that's going to bring into the environment. But then for pension shut-ins, people with disabilities, it's a life-saving technology. People will be asking for this for the improvement that it gives for their quality of life and even improvement in productivity, right? There's data that shows Europe being so under-penetrated in air conditioning, it's pulling back its productivity as a region. So air conditioning is something we would invest in because we think in aggregate, the puts and takes, it's improving the quality of life for humanity. On the flip side, there's a lot of data that says as the climate crisis continues and average temperatures go up, the demand for sugary drinks is actually going to go up. But you know what? I'm not going to invest in bringing sugary drinks to the marketplace because though I look at it and say, I understand demand will be there, I don't think that's going to dramatically improve the quality of life for humanity. I think that's going to lead to continued health issues and things like diabetes and things like that. So it does reduce some of my investment space. But overall, we think that we're so early that we'll still be able to create a portfolio that really is impactful, drive capital and innovation dollars into that space so we are additive, and be able to come out in a way 10 years from now that we're really proud of the portfolio we've put together. It's a for-profit fund that will deliver great financial returns and at the end of the day, improve the quality of life for humanity.
Darren, let's go a bit deeper into the types of opportunities within adaptation that you're excited about. And really, I think that you've made a distinction in setting up your fund between infrastructure plays and consumer-facing opportunities. I might be mistaken about that, but if that's true, why are you focused on consumer? What's more compelling or interesting about that area?
I wouldn't say that the distinction is in the infrastructure versus consumers. It's that we are very conscious that we do not set or define what adaptation looks like, nor are we trying to use an academic version of adaptation. We're trying to use a market definition of adaptation. So for us, our definition is actually quite simple. Like any adaptation technology or product is simply a product or service that will increase in demand as the climate crisis continues. So we let the market tell us what adaptation is going to be required and where it's going to be asked for more as demand signals will be driven for this. Now that naturally means it's a lot easier to see this in some of the B2C world in the concept of demand adaptation of where will people be asking for different things, the air purifiers, cold supply chains, ice cream, sugary drinks, cool vacations. It'll be very clear that a lot of these things are linked to demand increases from higher average temperatures. But you'll also see demand increase in the resiliency space. You'll see demand increases coming in the repair and recovery space. So we tend to group it much more around what are the challenges to scale, and where does that intersect with increases of demand from the climate crisis continuing? So resiliency companies all have a common challenge to scale. Repair recovery companies all have a common challenge to scale because of the intermittency challenge. Demand adaptations all have a common challenge to scale because they generally are more traditional businesses that don't have the same, aren't venture backable because there's just more products or services that people aren't used to investing in.
Darren, you've mentioned 3 different categories there. There's resilience adaptation, there's repair and recovery, and finally, demand adaptation. I'm curious if you've gotten to do a size of market analysis against these and have a sense of how much you'll invest across these 3 categories.
In answer to your question about the size of the different markets, I think we look for outside evidence, right? I go back to this Tailwinds report that says the resiliency adaptation demand somewhere in the 1.4 trillion going to 9 trillion. I think it does a good job, especially in this GIC report saying it's going to be about 9 trillion. Currently, in the repair and recovery side, Aon's come out with a report that says it's about a $350 billion market. You just look at events, climate-driven events, they've caused over $1 billion loss around the globe, and that's what that sort of comes up to. The demand adaptation, interestingly enough, I don't know of anyone else who's really sized this market. And because it's a really hard problem, there's some things that are somewhat easy to think through, right? You can do weather-driven demand models and say, what are some of the shifts that we're seeing there? And, will we see increase in demand from climate-controlled agriculture and things of that nature? Sure, that you can actually do some sort of sizing, but it's really hard to think through some of the second-order effects. So taking an example, something like night markets. As we get hotter and hotter during the day, more things will be pushed into the evenings or the cooler times. In North America, will we eventually have siestas? Will we do our shopping at night? In night markets becoming a place for people to socialize and be able to have a sense of community around. Some of these second order effects, really tough to estimate. And so there is going to be a place where the demand adaptation, we're still trying to fully wrap our heads around it and are looking to find some partners in the academic world to do some more research on this, to come out with a better estimate of the size of the market, the size of the opportunity, and also how to prioritize them.
Darren, you've mentioned that one of the challenges facing adaptation companies is scaling. And you've written that business models, not business cases, are the major challenge in scaling climate adaptation technologies. What do you mean by that? And how has it informed your approach at Adaptus?
I think if you look at in the mitigation investing space, and you see wind and solar that have gone so far down the cost curve, it is now in people's self-interest to do this, for the economic buyer in these cases to buy that technology. The great example is that if you can make the business case right, you're going to get adoption, not adaptation, but adoption of the technologies. So wind, solar, great business cases. On the flip side, hydrogen and DEC, we've thrown billions of dollars into them. And unfortunately, we haven't found clear business cases where people are buying it for their own self-interest. So they're not really scaling as fast as we expect them to. So take a look at that same analogy and then start applying it into the adaptation space. In adaptation, you're going to see a lot better business cases. This is back to this 10.5 return for every dollar invested. So the business case is fine. It's the business model of how do you actually bring this to the marketplace that's going to be the issue. How do I was talking with the head of a major private equity fund that owns a large real estate portfolio. And I was talking to the head of ESG there. And they were saying, hey, within our fund, it's a lot easier to spend $100 million in more growth than it is to spend $100 million in resiliency in our portfolio, because the investors understand growth a lot more than they understand resiliency. And this is why it's not the business cases that's the problem, that we have the evidence to show that they're strong. It's the business model and how do you convince people, get people to buy, or in the repair and recovery space, deal with the intermittency challenge that's there. You may go 3 years without having significant revenues because no events have happened. That's wonderful that no events have happened. But it's really hard to build a business when you just get revenue spikes once every 3 years. So these are the things we're consciously looking at when we look at startups is what's the revenue model? What's the defensible moat? How are you going to get people to buy? How can we help you get people to buy? Because the companies that crack this are going to be the ones that are dramatically successful.
Darren, I'd love to get specific and hear about some of the companies or at least types of companies that you're targeting. And you've mentioned air conditioning, you've mentioned air filters. Give us a sense of some of the companies that you're partnering with or hope to support in the future.
We have some companies that are like window films that you would put on a building to retrofit a building where under a certain UV index, it will always stay clear. As in the wintertime, we will let in as much sunlight as possible to help us heat the space we're in. We want the sun in the wintertime. In the summertime, higher UV rates, the film will start tinting and can block out 80% of the sunlight. So now in the situation where it is hot, it is summer, high UV, and the sunlight is shining on my window, it'll automatically act as, a sunshade and be able to block out that and make it a lot easier to cool the space. Right. So this is an example of a technology that we like because in the wintertime, it is adapting to the winter. In the summertime, it adapts differently. Right. And you're able to capture the benefits that are there. And it's all about, can you make the cost go down as much as possible so that people will adopt it? We look at things like that versus, another one is a foam sprayer that will actually be able to both do things around crop frost resiliency. So this way then as we have more frost and it changes when it happens inside of the year, this will be able to help prevent that for high value crops, as well as the ability to spray it on the ground so that way it can actually deliver things around pest control. Right, with multiple use cases around both, and the IP there is around the ability to administer the foam and its biodegradability, so that way the carrier is something that's okay for the environment, and the ability to actually spray it on in a unique way, so that way it gets cheap distribution, can just be added on to existing farm equipment. So these are all places where, or at least here's some examples of things where demand clearly will increase. As the climate crisis continues, there'll be a lot more pests. There'll be a lot more ask for cooling solutions as the climate crisis continues. And then we're looking at it going, hey, can we help them go to market in some different way? Or can we help them with their business and the strategy in some different way to help make sure that they're successful?
Part of your thesis is that climate adaptation founders need some extra support. And in addition to investing financially, Adaptus aims to offer hands-on support as a venture builder. Will you share a bit about this side of your business? Why is it needed? And what sort of support do you see as most helpful?
So if you think about this being such a new space that the world's never had to go through, it's not like this is software. We've done it 5 times. I've already sold companies for billions of dollars. And you're going to have VC funds just throwing money at founders saying, hey, do whatever you want with it. It's a new space. And the solutions, we're not going to solve the adaptation crisis through a bunch of software solutions. They're needed. We need things around risk identification. And I see so many software solutions, which will be great for society. But it's the second part of how do we go and tangibly change the world and change what we're doing in the world that is really going to be the solution here. And in these spaces, there just aren't a bunch of successful startups I can go and point to and say, hey, this founder's done it 12 times or 5 times, and let me go invest there. And so this means what we will have is strong technical founders who have some unique technology to bring to the market, who probably coming out of university or spent time doing research, they probably haven't done this so many times before. And getting their technology scaled to the world is what's going to make the difference. So you're very much designed around, instead of being a solution looking for a problem, as a fund, we're really designed around this problem of how do you scale and implement climate adaptation technologies? Let's work backwards from where the opportunities are and where the gaps are, and be able to then try to provide what is needed to make the companies more successful. So this has us not just having a venture capital fund, but also having a venture builder model By venture builder, I mean it'll be me and members of my team that go in short sprints to help the company that we've invested in accelerate one part of their business. Now, we're really clear that we can't do this in the company's core tech stack. The core technology, of how a window film will shift shading, man, can't help there. But the transferable business building knowledge, things like strategy, go to market, how do you go and scale this, and what's your manufacturing plan, your employee value proposition to attract the best people, using finance for growth, so that way you speak about your fundraising very differently. We talk to founders, we hate it when they just say, oh, I'm raising $1 million for my pre-seed. It's like, no, tell me what you're going to de-risk in the business. Talk to me about how you're going to prove product market fit. It's going to take you 12 months to do that. So you're raising $1 million to survive for 18 months. So you have some buffer. And once we prove product market fit, that should be a 3x increase in valuation. Oh, that's a very different story when you're going out and talking to founders. And so how do we help people do that? And then also AI for acceleration of the business build. Right. So there's 6 big places that we help to be able to really help the companies try to grow and accelerate faster. And this is just trying to address this hole that we see in the market, or this challenge of strong technical founders who could use someone to be more supportive.
And how critical is fit of the venture building side for your portfolio? As in, are you more interested in companies that take both the capital as well as the venture building, or are you interested in investing in companies that don't need the venture building as much and really are just looking for an investor?
So the way that we structure this, first off, the venture capital is first. We are venture capitalists and we're equity investors before we are venture builders. We're super open about this, which means we'll always try to make sure that we have more money invested than we're ever doing in the venture builder side of things. Then the venture builder, the way we finance this is we do this through a line of credit, a venture debt. So this way, imagine a company at pre-seed, we maybe have invested $500,000 in the company. We've provided a $400,000 line of credit in addition to the $500,000 cash to be able to help them build their business in a sprint model. If they don't use this, that is great, right? That means they've scaled and they've moved forward and everyone is happy with what's going on because we're equity holders first. If they do need help and there's places where we can help to be able to provide additional returns, then we will be happy to do so within the venture builder model that we have. But because we're equity holders first, that really takes the focus. And if you think about this from a founder's perspective, because what ends up happening with the venture debt is oftentimes we just convert it at Series A or Series B. They're oftentimes using their Series A valuation to finance a pre-seed acceleration of their company. It makes sense for a lot of people because you don't pay any cash up front for the venture builder.
Darren, I've noted that you emphasize that Norwegian talent is backing your venture building capability. And it's no knock on Norwegians, but it's funny to see any nationality singled out. Is there something unique and differentiating about Norwegian expertise that makes them the best fit for accelerating adaptation ventures?
Oh, you may get me in trouble with this one. It turns out that having spent the last 5 years living in Norway, the people here are amazing, right? Really highly educated. It's one of the great things about the country that's here, but just some top-notch talent. And the higher and the better the talent, the more relatively underpaid they are compared to other places in society. So you look at people with a STEM or MBA background plus 5 to 8 years work experience, the ideal kind of business builder you'd like to have, they generally get paid 37% less here in Norway than they would get in the United States. And the further you go up, so the more unique the talent is, the bigger the arbitrage becomes. This is because of a cultural thing here in Norway called the Janteloven, where everyone should be equal. So they pull the high-end salaries down, they push the high-end salary or the low-end salaries up, so that way everyone is roughly at the same rate. But this creates an opportunity. This creates an opportunity for me to be able to use highly educated Norwegians, partner with them, to be able to build businesses around the globe. Because since we invest across North America and Western Europe, I won't be the local venture builder partner for you. It's going to be a remote delivery model. So it really doesn't matter where I position my venture builders out of. What matters is, are they talented and can they go and deliver it? Now, on the flip side, Norwegians are used to the idea of working a 37.5-hour work week. And so there's a question of, even at scale, when we're into Fund 4, can I find 50 Norwegians here who have the aptitude and interest of working more startup hours and like pushing to get things done? But I think the answer is yes. In this country of amazing, highly educated people that are willing to be paid less so they can live in Norway, I think it's actually a great partnership. They get exposure to international companies. We get the talent, and they get to keep working from Norway. We'll fly them once every 8 weeks to wherever the startup is, so you can still spend some time working in person, but then the rest will be delivered remotely.
Darren, your website outlines several goals for Adaptus. They're the ones we'd all expect. Reach over 500 million in assets under management, invest in 250 companies with a healthy number of successes and home runs. But the goal that's listed first surprised me. It says we're building a movement, not just a fund. Tell us what you envision.
I just go back to fundamentally, we're trying to improve the quality of life for humanity. This means that I look at this 50% chance of it being a 2.3 degree plus pathway, and the fact that it's only 5% of money going into adaptation. That to me seems way out of line. And so why do I spend so much time being here on podcasts? Why do I spend time talking to different people and publishing different information on the space? Is because we want to see. I'm not shy about what I'm building and why. I think it's all about execution. And the more people who come and join me in the space, great, the better. That's the idea of getting the movement currently going, that people are starting to find a better balance between mitigation, which absolutely still needs to be there. I mean, you spend a bunch of money on that, probably over 50% of the money there, but it just can't be 5% in adaptation.
In the short term, the next 1 to 2 years, what do you hope to achieve with Adaptus, and what do you need to get there?
As a emerging manager, I'm having the same struggle of the startups that I'm looking to fund are. How do I go from 0 to 1? How do I go from this is an idea into something that's being built out there? And ultimately, in the short term, there's no doubt that finding LPs and funds and high net worth individuals to back this, who look at this like they would any other startup and say, hey, we see what Darren's doing. We can actually grow with him and help him through that would be the best thing. So people who are interested in investing in the adaptation space. First stakeholder that over the next little while to get this up and running. But then this quickly starts shifting into more and more entrepreneurs, finding the right companies that we're going to invest in. Now, we do have some tricks up our sleeve there that is, we're setting up with my co-founder, who's an AI expert out of San Francisco, where we're using a lot of AI to identify the startups that we will be investing in, or at least shortlisting them, so we can be more efficient in our and more effective in our outbound reach out to. So getting some of this core structure set up of our fund that we can use to then continue to find the best companies is the second big thing to do in the next 2 years. And the last thing is building out our team. It has to be more than just me involved in this. So finding other people who are interested in joining our fund. I think at the end of the day, the single biggest constraint for growth for us is going to be finding 15 GPs in our fund for that $500 million assets under management that we're trying to do. And that's just because a GP in our fund needs to be able to allocate capital. They also need to build the relationship with the founder so that way then they can help accelerate the business build. And oftentimes, you find former operators, they're good at operating when they're in charge. It's different to lead through other people. We're very conscious that the founder still owns the business, and we want them in that role for a reason. We're not a venture studio where we come up with our ideas. We want to support founders, which means that we need to find people who can lead through others to be effective. And so that GP role is quite a difficult role to recruit for, and it's quite unique people. And finding more of those people who want to come and partner with us to be able to deliver that impact is the third thing that we're really trying to stand up over the next 2 years.
Well, hopefully lots of potential GPs, investors, and partners have heard this episode. Darren, wishing you all the best of luck. Thanks for your time today and for the work that you're doing.
Thank you, Jason.
Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.